Okay, today this is class 8 of the session 3. Welcome everyone that's in class. Others will join us as we go along tonight. But we're going to go ahead and get started. Tonight we'll be looking at a very important topic as we begin to build towards using some of the skills that we've been gathering in investing. We spent a lot of time in the first half of the class, which we wrapped up last Friday, trying to help us to set some foundation with planning for the long term and budgeting and figuring out how to do that effectively. The next level now is once we have done that effectively, we are ready to start investing. Most people jump into investing without doing what we have done for the last 7 weeks, and they find themselves in a very bad shape. Investing is not gambling. It's really about planning for the long term, sowing and working towards long-term returns. That's really what investing is about. But if one is not thinking in that fashion, you will make a lot of mistakes. So tonight we'll start looking at if I've done a good job laying the foundation as we've done in the last 7 weeks or so, and I have set some funds apart to use for investing. How do I identify good investment opportunity? That's really the second half of this school. Today we'll look at what I call intelligent investing. It's a very brief summary of a book that I've asked us to buy, titled Intelligent Investing by Benjamin Graham. I still strongly recommend that. We'll look briefly at some important principles from that book, talking about intrinsic value and what is called the margin of safety when you're investing. Then we might be able to start looking at financial statements today under fundamental analysis. If we're able to, we will look at income statements. If we're not able to, we will start it next week. So under that next section, after this intro today, we'll do the 3 different key types of financial statements, which is income statements, balance sheet, and cash flow statement. Then we will look at technical analysis, which is how do you use charts to understand what is going on in a business. We'll look at some very important elements of technical analysis. That will likely take us 2 classes to cover it effectively. And then we'll round up with introduction to negotiating skills. The last class is an optional class. It's just to give us an opportunity to Q&A if we want to do so. Okay? So we'll go ahead and start with intelligent investing, which is the focus of tonight's class. All right. So I would like to start by saying, we will look at different types of investing or different types of stocks later when we look at technical analysis. But for tonight, I want to talk about this, which I will delve into a little bit more when we look at technical analysis. What is referred to as value stocks or value investing. There are some investors that all they do is what is referred to as value investing. And really, value investing is about looking for opportunities that have potentially high upside. Companies that their stock, for whatever reason, in the short term, is not in high demand. But the reason causing that not being in high demand is truly not linked to the fundamental worth of the company. It's linked to other issues. So as a good investment student, you need to be able to calculate the fundamental worth of a company, which is what is referred to as the intrinsic value of the business. If a stock is trading below its intrinsic value, that means it's at a point where it's likely going to rise towards its intrinsic value and possibly even go above that value. So as an intelligent investor, you need to be able to figure out what is that cutover point and be able to look at each stock from that point of view. Okay. So generally speaking, you say value stock is a stock that's selling at a bargain price, And as an investor, if you're able to identify that investment at a good time, it's likely going to rise in value and you will make money as a result of that rise in value. Okay. Most of these stocks, the reason that they are trading below their real value or the intrinsic value is linked to some really, you can call it flimsy reason. Maybe the CEO of the company went to a party and he did something that is considered not a good thing to do. Those that are investing in the stock might, as a result, begin to value that stock for the short term not very favorably and result in it trading below its intrinsic value. If you as an investor are able to identify such investment, then you stand the opportunity of making some profit as it rises back to its correct valuation, and might emerge out of that undervalued position into a more favorable point, which is where it ought to be. Okay. Of course, there's a risk of it not emerging. That's why you need to know why is it trading below its true value or its intrinsic value. So the key point is as an intelligent investor, which is what you all are becoming, every one of us, I should say, is becoming, you're getting to a point where you can actually look at a stock and look at the company's financials and be able to say, this stock is a bargain to buy, to use that word bargain, or maybe not. That is, it's a value stock. Okay, so that a key principle that I'll be bringing out of that book, Intelligent Investing, is the principle of intrinsic value and the associated margin of safety. I'm going to use this chart on the left frame of my screen to explain both the intrinsic value and the margin of safety of any stock. So this is a simple XY chart from mathematics or high school algebra. An XY chart has a vertical axis, normally referred to as the y-axis. In this case, what is posted on the y-axis is the value of the stock, which will also be the price of the stock. And on the x-axis, the horizontal axis, is time. So what is plotted here is the price of that stock over time, any particular stock. So when a stock is trading on a daily basis, the price goes up and down. On a weekly basis, on a month, even on a by-second basis, the price of a stock is going up and down. And like I told us in this class many times, it does not matter at all whether the price of a stock is going up or is going down. If you look at the market today, for example, the stock market is hitting all-time highs today. For those that have paid attention, the S&P 500 hit an all-time high today. It's never gotten to the level that it got today in history. At that point, most people are getting excited. They want to invest for whatever reason. And it might tend to push the price even higher of the stocks that are represented in the S&P 500. So the price of a stock will go up and down. As I've said many times, it doesn't matter. What matters is the value of the business that you're investing in, and you as an individual are controlling your emotions and knowing that you are not investing in what you see on TV. You are investing in a company. And by nature, I've explained this in the class before, companies by nature are designed to grow. Every company is in business for growth. There's no business meeting that I've been in that the leaders in the organization are not always talking about growth. Growth. What can we do to maximize our ability to grow this business and to keep profits margin in the level it ought to be? So if a company is growing, the underlying stock will also grow. So that is what you want to focus on, not on what is happening on a day-to-day basis. The stock market goes up or goes down. It means very little for a true investor. Okay. However, the stock price, like I show here, on this chart, on this XY chart, you can see it going up and down. The time here could be daily or whatever the time frame is, could be monthly, could be weekly. Let's assume it's daily, okay? And this stock went up, came down, went up, came down, went up, came down. For some reason, it went below this line that is labeled intrinsic value line. Okay, it went below that line. And then it went back up with time. Let's assume actually that this is weekly numbers, okay, or even monthly numbers. So month 1, month 2, month 3, it went below in month 4, month 5. By month 5, it started trending back up towards its intrinsic value. And around month, 6, 7, thereabout, it got back to the intrinsic value. And after that point, it began to rise above its intrinsic value. Okay? Every stock will do like this on an ongoing basis. Every company stock, I should say, will do like this, will behave like this on an ongoing basis. And as an intelligent investor, which every one of us is becoming, you need to be able to identify this intrinsic value. The intrinsic value essentially is the true value of the business, which is what I define on the top right of this screen, is the true value of the business. That is, if you take all the company's assets and you take out its intangible assets, okay, and its liabilities, you come to the point of book value, also referred to in the book Intelligent Investor as intrinsic. The word intrinsic means inborn, if you want to say it that way, the true value, the native value of the business. So essentially, when you subtract the liabilities as well as intangible assets from the total assets of a company, that is, when you subtract liabilities from the tangible assets of the company, you come up with what is referred to as the book value of the company, which is essentially this point in time for any business. Now, this class tonight is very detailed, very deep. There's a lot of numbers that we'll be looking at. So please feel free to slow me down. If something that I'm saying is becoming a little bit too technical, please raise up your hand and let's discuss it. There's no need to rush through it and leave anyone behind. So please feel free to slow me down. Okay, so like I was saying, if we consider this as, let's say, monthly scale, this time on the x-axis is in months, and these numbers, I'll just, as an example, say the first one is 10, 20, 30, 40. So the stock was trading around $35 here. And then by month 1.5 or close to 2 months, it traded below to about $20, which was its intrinsic value. That intrinsic value also grows with time, like I was saying earlier on, because the business is growing over time. Okay, so the assets of the company is growing, so its intrinsic value is supposed to be growing. All right, but for whatever reason, as I was explaining in the earlier slides, it fell below its intrinsic value. See, as a good investor, if you are able to identify what the intrinsic value of the business is, and you then buy at this point when it's trading at $10, when its intrinsic value at that point in time should really be about what? About $32 or $33. If you purchase it at around this $10, you have an opportunity to profit because by nature, the business has asset, true value, that will force the price of the stock to rise back towards its intrinsic value by nature. Okay? They say whatever goes up must come down. It's similar to this, even though it's like in the opposite way. It's gone down now and it has to come up. It has to come up and rise back towards its true value, the company's true value. So what I'm saying in essence is that as an investor, you need to be able to identify companies that are trading below their intrinsic value. And you do that by simply subtracting from their tangible assets all their liabilities. That is the true things they own. When you subtract that, you come to a point of understanding their intrinsic value. Anytime it's trading below that point, is your investment opportunity as a value investor. Remember at the beginning I said the focus here is on value investing. We'll talk about different types of investing when we look at technical analysis in future classes. But here it's on identifying value investment opportunity. I see a hand up, Shakira.
Yeah, so I have a question.
Yes.
In the case where I know everybody would like to buy at the value where it's below the safety, or where the safety of margin, the margin of safety. But how would you be able to tell if the company is actually in trouble? That's why their stock price is down.
Yeah, so you must have missed the beginning of the conversation tonight.
I did, I'm sorry.
Yeah, so I said it doesn't necessarily mean, so I said here that the risk of investing in a value stock is that it may not emerge out of that state of being below its intrinsic value. Because the reason usually that forces it below the intrinsic value are not things that will last forever. But in some instances, there is something else going on within the company that pushes the price below the intrinsic value. If that is the case, you need to be able to read that by looking at the company's financials. Okay? So those are things that you will find out by reading through the company's financials in detail. I will look at financial reports as part of this class. Okay, but generally speaking, you will be able to identify, those companies that are trading below their intrinsic value. That is, they have a margin of safety. Your goal in that book that I've recommended, Intelligent Investor, is to find companies that are trading, in those levels, and let that be your cue to purchase investment in those companies. And naturally, you will profit from this margin because it's below its intrinsic value. Now, a true value investor, once the company's stock gets back to its intrinsic value, it is your cue to sell. Because usually what happens is similar to what is happening in the market right now. People are excited. I said at the beginning that the S&P 500 has just gotten to a peak of a value that it has never been, ever. So at that point, everybody's excited and they want to purchase stocks. And really, if you invested as a value investor, that is when you should be getting out. So if you see at this point, there's something causing fear. To your question, Shakira, there's something causing fear. It could be the CEO of the company that did something that, the market did not look at favorably. Or it could be like what happened last year in the market with COVID-19. There were a lot of opportunities, Shakira, last year to invest as a value investor. So many of them. I mean, almost every stock actually was a value investing opportunity. Not all of them, but majority of stock presented value investment opportunities in March of last year. And if you as a student of this class can identify those opportunities, because they will still come. Opportunities like that will still come. It's just that you won't always have a massive opportunity of almost every stock being like that, like we had last year. So you need to be able to look at opportunities, individually. Okay. Does that answer your question, Shakira?
Yes, it does. Thank you so much.
So generally speaking, as a value investor, at the point where the price of the stock rises back to its intrinsic value, let's say you purchase it around $10 here. Just like I said, for those that were here earlier, I'm calling each of these mark $10, and each of these is 1 month. Okay, so it's risen back from $10 to $40. So you've made about $30 per share. That is your cue to sell if you are a true value investor. Now, I'm not saying you have to sell or you must sell, because you can see that it's still rising. In this case, it rose to, let's say, 50, 60, 70, 80. There's still an opportunity for you to make even additional $40, $50 per share. But what is driving it on this other side of the intrinsic value is more greed than the true value of the business. Okay, it's more people looking at what every other person is doing. Everybody else is investing in that company, so they are also investing. Now, again, it doesn't mean you can't invest here. We're going to be talking about this, investing in this level of stock performance when we do technical analysis in more detail. In fact, this also poses its own investment opportunities. Okay, but from the point of view of identifying value investment opportunity, this is what you want to see. A stock trading below its intrinsic value, ride the wave till it gets to the intrinsic value, and then puts the order out that if it ever falls below that point, your stockbroker should sell so that you don't lose the profit you have made. And I will show you how to do that later. Okay, but like I said, doesn't mean you have to sell. It's just that it triggers your selling. You know you've made your profit at that point, and you're ready to sell if something else happens in that company later. But if it doesn't go down, you can still ride the wave and sell sometime later in the life. Okay, so I've defined the book value. We're going to do an example on how do you truly calculate book value in a minute. So the margin of safety, again, is the book value minus the price of the share, okay, or the intrinsic value minus the current price. That is your margin of safety. Does that make sense to all of us? The current price it's selling, the book value minus that value is your margin of safety, and that value changes over time because your current price changes with time and your intrinsic value is also changing. Okay, I also said that fear, which is usually driven by some unfavorable type of situation, is what typically drives the stock below the book value. Speculation, on the other hand, drives it above the book value. And this is happening a lot right now in the market. Okay. All right. I have two examples that I've pulled here, and we will actually do some work. I will share a template with us after this class. But these are two examples, two companies. One is called Marathon Oil, and the other one is called Cheesecake Factory. I think most of us will know Cheesecake Factory, but maybe not all of us know Marathon Oil. Marathon Oil is an independent exploration and producing company in the oil and gas industry. Cheesecake Factory is a restaurant, a very big restaurant chain. I'm sure they're all over the US, if not even outside of the US. Okay, so I looked at their financial statement in 2019. I pulled this on the 11th of June and this on the 5th of June. And in order to calculate and define the margin of safety, you need a few items from the company's financial statement. You need some items from the income statement and the others from the balance sheet. And I will show you in physical example where does that come from. In fact, we will have an assignment in tonight's class to calculate to do a similar exercise for another company. Okay, so if we look at Marathon Oil specifically on that date, its number of shares outstanding, which is shown in the income statement of the company, is 810 million shares. Its price per share, which is also shown in the income statement, is $6.26 per share. Okay, so the first thing you look for is what is the current price of that share, 626 in this case. How many shares does it have outstanding in this case 810 million. And then you go to the balance sheet for the company and pull these items, the total asset T of the company, the goodwill of the company. The goodwill, another way to think about goodwill is the name the company has in the market. It's not really brand. It's related to brand, but it's not brand. Goodwill is actually an accounting value that can be numbers can be associated with goodwill. That is, an accounting value. Okay, so it's related to brand, it's related to name, it's related to how well the company has managed its business over time. Sorry about that. Okay, so the goodwill, the intangible assets of the company, and then the company's liabilities. Remember when what I said earlier on, to calculate the book value, you subtract the liabilities from the tangible assets. Now, the tangible assets essentially is all the assets minus intangible assets. So goodwill is an intangible asset, and then there are other intangible assets. An example of that would be something like the copyright. If a company has copyright, that copyright is an asset, but it's not tangible. It's not physical. You can't see the copyright. It might be on the paper, but you can't physically see it other than what is written on the paper. So those are considered intangible assets. So you subtract the goodwill and the intangible assets from the total asset to get the tangible asset, and then from that you subtract the company's liabilities. When you've done that, you have calculated the total book value of the company, okay, which is the T minus G, I, and L. All right, that gives you the book value. And all you need to do is to divide the book value by the total number of shares outstanding to get the book value per share, because the price of stock is quoted per share. So you need to calculate the book value per share. If you look at these numbers that I quote here, based on what I explained on this slide, the price of the stock is $6.26. The book value is $14.89. Is the stock trading above or below its book value? I would like somebody to answer that question. I'd like somebody to answer that question, please. Anyone?
Its book value, sir.
Below.
What did you say, sir?
Below its book value, sir.
Below, thank you.
Below.
The number is less than the book value, so it's below the book value.
Yeah.
Okay, you can do a ratio called the price to book ratio, the price per share to the book value per share. In this case, 6.26 divided by 14.89 is 0.42. If the P/B ratio is less than 1, that is an undervalued stock. It's a value share or value stock. That stock is undervalued, and it's essentially behaving like I was explaining to us at this point, for one reason or the other. Now, as Ms. Shakira mentioned, you need to understand what is that reason, because it might be something else is happening in that company that shouldn't make you want to purchase it. But at this point, this company represents a value investment. It's trading below its book value. So that means as an investor, you need to be able to read the financial statement, particularly the income statement and the balance sheet. The cash flow statement as well, but these two you need to be able to read very, very well. And the margin of safety, remember, is the difference between the intrinsic or book value and the current price. So based on that, the answer is on the screen, but I will ask it as a question. How did I calculate this margin of safety that came to be 8.63?
So that's 14.89 less 6.26.
Okay, you subtract 6.26 from 14.89. Thank you. So the margin of safety is $8.63. In practical terms, what it means is for every share of this company that you buy at $6, you have the potential of making $8.63 per share on its rise back towards its intrinsic value. That is a very good investment opportunity. By the time you get back to its book value, you will have made over 100% of your investment. Over 100%. If you invested 10,000, your money will have become over 20,000 by the time it gets back to the book value. Okay, so you need to be able to identify companies that are performing like this. Let's, on the other hand, look at Cheesecake Factory. Similar analysis, the same analysis actually. Their shares was 45.545 million. They were trading on that date for $22.20. And the same analysis of the total assets, goodwill, intangible, and liabilities placed their book value as 13.535 million. Doing that analysis, 13.53 divided by 4.54 equals to 3. So the book value is $3 per share, but it is trading at $22 per share. So if I go back to that chart, the book value here is $3, but the company is trading at $20+. So it is trading above its book value. It's trading above the book value. So it's overvalued, okay? It's overvalued. It's trading 7 times its book value. The price to the book ratio, P to B, 22 to 3, is 7.35. It's overvalued, significantly overvalued. And obviously, it has a negative margin of safety, right? The margin of safety is the difference between the price and the book. And here, the price is higher than the book, so it's negative. Essentially, 3 minus 22.2 is minus 19. Okay? Is this analysis that I have explained here, is it clear to us? It's important that you get this because this represents some very good investment opportunity if you understand how to do this effectively. Any question on what I've shown us so far? We're going to do some examples. Yes, Tolu, go ahead.
Thank you, sir. I just wanted to find out that, we pulled the income statement to be able to calculate this book value to find out whether it's undervalued or overvalued. I wanted to find out, is there a time component because if you look at this, the price date is June 11, 2020.
Yes.
And then we're looking at the income statement. Is there a time component to knowing, okay, this income statement that I'm pulling is significant and has relevance to the price date that I'm looking at? Is there a way to do that?
Yes, absolutely. Thanks for a very good question. So ideally, you want to pull the statement of today. Ideally. Unfortunately, you won't always have the statement of today, right? So the latest statement is what we can look at and compare with however the stock is doing currently. Ideally, it will be the most perfect case scenario would be to look at today's numbers, but those numbers are not published on a daily basis.
Yeah,
they are published on a quarterly.
That's why I was asking.
Yeah, they are published on a quarterly basis. So there is a little bit of a lag in time. So ideally, you want to make sure that there is significant margin of safety. So it's not like 10 cents or 20 cents, where time has actually eaten whatever you're thinking it might still have, as it were. So very good question.
Thank you.
Yeah. All right. So now let's look at this in a little bit of practical terms. I see Shakra, you have your hand up.
Yes, I had another quick question.
Yes.
So everything you have said so far is very clear, except for the part of intangible assets. Okay. How differently will it go from company to company? Because you mentioned one might have copyright listed. How would you be able to differentiate on a balance sheet what it is?
Yeah, so the balance sheet will state, right? And it will also vary from company to company. A company like, let's say, Walmart, for example, will likely not have a lot of intangible assets because they don't have like proprietary technology. They're just buying and selling.
I see.
A company like Tesla, on the other hand, will have a lot of intangible assets because part of what they are selling, I mean, really, if you think about what it costs to build a Tesla, are we saying it's going to cost 80,000 or 60,000 to build that car? More than likely not. I doubt if the cost of the car, the actual cost of building the car, is more than maybe $15,000 to $20,000. Yet they sell it for 80,000, right? Because there is something in it that will still make people want to buy it. You buy an iPhone for $1,000. To produce this iPhone, I can almost bet it doesn't cost more than $100 to produce it.
Mm-hmm.
So there is a reason why people are willing to pay that premium, which is usually eating into the intangibles, more of things that's not easy to quantify, as it were. So company to company, the intangible assets will vary. So it's a good question. So ideally, so for this particular analysis, you're looking at company to company. You just want to identify if a company is a value investment opportunity. But kind of to take your thoughts to the next level, when you're doing, should I invest in two companies that are similar? Okay. If you have two companies that you're looking at, and let's say both of them happen to be value, stocks, then you need to look at other things to decide, should I invest in this one versus the other one? Okay. You need to look at a couple of other ratios, as it were, that indicates how the company is behaving versus the market or versus other companies in the same, that's what they call to price to earnings ratio, for example, or the earnings per share. Look at other things that can help you to distinguish a company, two companies that are similar or comparable in terms of your decision making. Does that make sense?
Yes, sir. Thank you so much.
Good. Pastor Dave.
Yes, sir. Yes, sir. Please, my question is similar to what she asked. So I was just trying to ask, is there any ratio to the kind of percentage we should be looking at in terms of the total asset to the goodwill?
Not necessarily.
Okay.
Okay. If you're looking at two companies, if you're trying to decide between two companies, all you want to do then is, okay, how is this company performing relative to the other? And there are ratios that I'll be sharing, kind of talking about when we look at income statement shortly, like the earnings per share. Is this company making more money for every share that is really invested, as it were? For every dollar that is invested in this company, are they doing better than the other? Okay. Or the price to earnings ratio, which is kind of the opposite of that. Okay. Is it more expensive versus the money that it's making? That's what the PE shows you. So again, that is trying to compare apples to apples. So, but when you're looking for investment opportunity from a value stock point of view, you don't need to do that. In fact, you don't need that. You just want to identify what is your margin of safety. Is there a margin of safety in the first place? And what is it? If it's significant, like I said, if it's too close because of the lag in time between when the financials are published every 3 months and the price of today, it may already have been eroded. So there has to be significant value difference. $5 on a $10 is significant, So your goal is magnitude is what you're looking for. Magnitude growth opportunity from where you're at towards the intrinsic value. Does that make sense?
Yes, sir. Thank you, sir.
Okay. All right. So let's look at, I have a spreadsheet which I will share with us after this class, and we're going to do an exercise. But I want to show you where those numbers are. This is going to be your assignment. So I will not do it in class. I'll take another example to do. I believe, yes. So the assignment for tonight on this particular subject is to conduct a complete analysis of Norwegian Cruise Line Holdings. The company's ticker symbol, the ticker symbol is the acronym that the company is used to be quoted on the stock exchange. The companies that have four-letter acronyms are normally quoted on the NASDAQ. Okay? If you look at Tesla, for example, TSLA is its acronym. That shows that it's quoted on the NASDAQ. If it's on the like New York Stock Exchange, it will have three letters acronym on its ticker symbol. So Norwegian Cruise Line NCLH, again, to Tolu's point earlier on, I need to refer to a particular point in time. So at the time I put this together, I said, based on 2019, I might change that. I should have a 2020 report now. So based on their last financial report, is NCLH a value investment? If so, what is its margin of safety? Does NCLH represent a good investment opportunity? Why or why not? Will you invest in NCLH? To Shakira that was asking a question earlier, will you invest in it? Why or why not? Because if it's a value opportunity, why or will you not invest in it at this time? What other concerns will you have? And I said here, look at it at their current ratio. I will explain current ratio to us later. One of the things that I will be sharing with us is this. I talked about looking at different ratios earlier on. I'll be sharing this with us, as part of this class or maybe the next class. Current ratio is current assets divided by the current liabilities. So that's what I was referring to, that you should look at the current ratio. But for the point of this assignment, if you don't get to the point that I have explained current ratio, don't worry about that question. Okay, I'm trying to get you to think about the company's liquidity or the potential for bankruptcy, really. Okay, and I have the reference here as Yahoo Finance. One good thing about Yahoo is a lot of financial reports you can get for free. Okay, so that will be your assignment, but we will do a similar exercise for Walmart. So what I've done with this spreadsheet is, you see what I did here on a, kind of coming down, I've made it to be one line. Okay, you can see that the example that I did for Cheesecake, if you just simply put the current price here, look at their shares outstanding, put it there, total asset, goodwill, intangible asset, liabilities, the software, not the software, the template will calculate the book value for you. So I've simply put the calculation in this gray section. You don't need to do anything, just fill the white section and the gray section will calculate. So the book value is calculated, the price to book value, and the margin of safety. They're essentially the same numbers that we have here for cake. Let's see. Yeah, you see that it's essentially the same as I have here, 735, 19.38. So this will do it for you. And then the last column here is this a value stock? Obviously, it's no, because that's a negative margin of safety. And the same exercise done up here was done for Marathon. Just put the numbers and the template will show you if it has a positive number, that means it has a positive margin of safety and it is a value stock. Okay, so we're going to do an exercise together. Your assignment is NCLH. Let's look at NCLH and see. Yahoo Finance, like I said, is very, very powerful. You can get a lot of useful information on Yahoo Finance. So I'm going to look at NCLH. All you need to do is click on it, open their current quote by typing NCLH in the quick lookup. And you can see that they have a financial report that goes now up to December of last year. So the first thing I will do before I send that assignment to Ross tonight, actually I'll go ahead and do it now. The question was to do this analysis for 2019, because when I put this together, it was in 2020. But now they have a more recent financial report. So I want to look at more recent financial report, also to Tolu's point earlier on. Okay, based on 2020 financial report, are they still a good investment? But I won't do NCLH for you because that is your assignment, right? I will do Walmart. I will conduct the same analysis for Walmart. Or let's do Oxy, actually. Let's do Oxy. I almost know that Walmart will not be a value investment, so let's just do Oxy. How many of us know the company called Oxy? Oxy is good. I think some of us know the company. It's Occidental Petroleum. It's an independent company similar to Marathon Oil. Okay. All right. So I typed Oxy in the symbol lookup, and it brought out Occidental Petroleum. So I'm going to click on it. When I send this link to you, for those that have not been in the class previously, you may not know the URL, the website address for Yahoo Finance. It's going to be in this PowerPoint, okay? So you can just click on it to go in there. But it's also at the top here, finance.yahoo.com. If you type that into your web browser, it will bring Yahoo Finance up to you. All right, so Occidental Petroleum is what I just pulled now, OXY. All right. I want to do the same analysis for Oxy. So I'll go back to that sheet that we have. For Oxy, today's date is, for the one for NCLH, I will change this date. Today is what? Today is 4/5, April 5, right? When you do your assignment, maybe you will do it tonight or not, I don't know. So I'd like you to do the one for NCLH. Actually, let me just clean up NCLH from here, put it on the next. I'm making things easy for you. I'm doing some of the work for you, really. I shouldn't be doing that, but I'm putting it there for you. You just need to put the date you do the analysis here and all of that. So, but for today, we'll do Oxy together. And Oxy is Occidental Petroleum, one of the largest independent oil and gas company, like Anadarko, Marathon Oil. They are fairly big. So the stock price, J column, what I'm asking you to look for is the stock price, current stock price. So you go to Yahoo Finance, and you can see that they show the stock price at the close of the market today. Okay, market closes at 4 p.m. Eastern, 3 p.m. Central. At the close of market today, the price of the stock was $25.31 per share. Okay, so you just put that number on that table. Next week, I'm going to ask somebody to show us your calculation for Norwegian Cruise Line, since I won't do it for you. Okay, so we have that. The next thing I need is the shares outstanding. Like I said in that analysis, that is obtained in the income statement, right? So I'll go into the income statement. Excuse me. How do you get the income statement? Once you open Yahoo Finance, I'll make it a little bit bigger. There are a number of items or menu items at the top here. The one you'll need to click on is financials. When you click on financials, it shows you at the bottom here 3 tabs: income statement, balance sheet, and cash flow statement. Okay. If I have one, the one highlighted, the one I'm working on will be black. The others will show blue. That is, they will have an hyperlink to open those up. I want to look at annual report. So annual is also showing as black. I don't want to look at the quarterly. I want to look at the year end, how is the company? Okay. They should have a quarterly report coming out soon. And also, to Tolu's point, you could also use the trailing 12-month numbers to do this calculation. It's just that the trailing 12 months sometimes will not have all the numbers you need to do your analysis. Okay. So for this example, for this exercise, we'll use the end of last year to do the exercise. All right. So we need to know the shares outstanding for this company. If you go down here, it shows that they have both basic and diluted shares. They've not quoted the one for end of last year, so we'll use the one for end of the year before. For now, you can see that the trailing 12 months, because it's an ongoing change, it doesn't have anything in there. But they have 805 million shares outstanding. These numbers are quoted in thousands. It says so at the top of the page here. all numbers in thousands. So 895, 809, million, 0.5 million. So all I need to do is actually to copy that number. You can do a Control-C on that. Go to the template, which I will share, and put it there. I'll multiply it by 1,000 because those numbers are in thousands, okay? I'll put my format so it's not taken. All right, total assets. We're going to spend time to look at those financial statements, starting from the next class. Yes, Tolu, go ahead.
Thank you, sir. So could you kindly show the screen for Oxy? Yeah. So I wanted to ask, what's the difference between basic average shares and diluted average shares?
Good question. Very good question. All right. So what happens in organization that issues share is there are shares that they are authorized by the Security and Exchange Commission to sell. Let's assume the company is authorized to sell 1 million shares, just to make it easy to explain, 1 million shares. They could decide to keep 200,000 of those shares in the company's treasury and put 800,000 in the market for those that are buying in the public to buy and sell. And out of that remaining 200,000, there are officers, there are CEO and the senior officers or some employees that do well. They may give them, you remember in the last class, I was talking about stock options, or the class before. They may give them options, which is some right, some, not a right, it's like the opportunity to purchase the shares of the company at a discounted price. Or in some instances, they actually just give you those shares outright as a benefit rather than as something you have to purchase. So let's assume they have now issued out 200, all the other 200,000 to their employees as stocks free of charge. What is said to happen there is that the stock has been diluted. So the way to think about it is each of the individuals that bought the 800,000, let's say they paid $10 for each share. So 10 times 800,000, the value of what they invested is 8 million, right? 800,000 times 10, yeah, 8 million. So the total value of stocks in the market is 8 million. Whereas now you now have 200,000 shares that are now in the market. So if you divide the 8 million by the 1 million, really the value of their share at that point is $8 rather than $10. So they've been diluted down in value because some people got it for free as incentive. Okay, so that's what is referred to as diluted shares. And what I always want you to pick is the diluted number of shares. You will see that it's always higher than the basic, So what you want to always pick is the diluted shares because it reflects the effect of what I just explained.
Okay. Thank you, sir.
You're welcome. Excellent. Excellent question. So the next thing I want to pull from this worksheet, is the total asset. Remember, like I told us, that will be found where? In the balance sheet, right? Again, we're going to spend time on each of those financial statements, so don't worry too much about it for now. I'm just kind of showing you how to look for answers to your assignments. So you click on balance sheet, and when you do that, it will pull the balance sheet for the company. I will explain all of this in detail. But the first thing that the sheet is asking for is what? Total assets in column L, which is similar to what I explained here. The total assets of the company. In this case, the total asset is what? Who can tell me the total asset? We're using end of December last year for now, so don't use this one. I know I used the shares at that point because they didn't post the one for this year. So let's just use, what's the total asset at the end of 2020? Anyone, please? It's on the screen. Thank you.
86
billion.
Thank you. 80 billion. It's really not 80 million. You see, it's 80 with 6 zeros, but since this is in thousands, Their total asset as a company is 80 billion. So I'm going to copy that and put it into my sheet. I'll paste it special. If you're copying things like that, always paste special. I'll just do Control V. Okay, let me redo that. All right, I think it pasted just the values. All right, now remember, like I said, it's in billion. Now, if you do this without the zeros, you will still get it because the zeros are going to cancel out. But I just want you to think, correctly. Goodwill. Again, the goodwill is obtained from the balance sheet. Okay, so we'll go in and see if the company has a goodwill. Now, goodwill is an asset. Okay, I will explain this later, but you will find it under what is called the non-current assets. Okay, again, I will explain that when we look at financial statement. But the company has no goodwill. Similarly, they actually, in this financial report, they bounded goodwill and other intangibles together. So their goodwill and other intangibles is 0. So if we go back to that sheet, you just put 0 here for goodwill, 0 for other intangible assets. Now, liabilities. Go back to again, that's on their balance sheet. So we'll go back to that and look at the total liabilities. You can collapse that. The total liabilities for the end of last year is 61.49 million times 1,000. So, yeah, billion. Thank you, Danny. So we'll put that in here and add 3 zeros to it. So if you do that, the worksheet will calculate everything else for you, right? It calculates the total book value, and then the book value per share, the price to book. The PB ratio is above 1. What does that tell you automatically? Is it a value stock or not?
Not.
It's not. Thank you. For it to be a value stock, the PB ratio has to be less than 1. And like I said, you're looking for significantly large PB ratio for you to invest. And then, similarly, the margin of safety is negative. Again, that tells you it's not a value stock, correct? So
Yes.
our answer here is what? Is it value stock?
No.
No. All right. So Oxy at this moment is not a value stock. Now, does that mean you shouldn't invest in Oxy? Not necessarily. But you need to know that you are not investing in it as a value investment. You are investing in it for other reasons. Okay. At this point, it's trading in somewhere in this range above its intrinsic value. Not too far actually from its intrinsic value. It's trading at 25, whereas its intrinsic value is 23. Just about $2 above its intrinsic value. This stock last year was, when I was looking at this analysis, it was a value stock at about June of last year. If we go back and look at, I'm going to go back in here and just type Oxy. Actually, I will need to go back to the main screen to do that. Okay, yeah, it's actually here. Summary. If you look at the summary for the company and just go back like the last year, last one year. See, the company in June of last year, June of 2020, look at the price was around $12. I don't know if you can see that on the right axis here, it shows the price. In May, June of last year, around June, it was trading between $12 and some $15, $16. So it was trading below its intrinsic value, again, depending with the time component at that point in time. Or, but it was trading below that $22. So those were potential opportunities, like I was saying earlier, to invest as a value investor. Now, like I said, there are other things to look at, and I will explain that to Ross in the next class. And that stems from where it's falling from. And I will explain that actually when we do technical analysis. All right. But for the point of answering that question, we know it's not a value stock. So you will, for your exercise from tonight's class, do a same exercise for Norwegian Cruise Line. Norwegian Cruise Line is a very unique story at this point in time. And what I would like is for you to actually read, there's a lot of useful information on this page, on this Yahoo page. Read a little bit about Norwegian Cruise Line. What do they do? What conversations are people having about them? What is their profile? If you click on this, it tells you about the company's profile, the directors, what the company does, okay? When you're investing, as I'm asking us to do, I want you to do what I'm saying here. Read about the company. Understand what the company does to make money. Because that is when you can only truly tell, is it in a business that is sustainable? Or is whatever making them successful a temporary thing that will change with time? So please look at those kind of things. I want us to start getting used to doing things like that. Okay, and then the charts, you can do some charting here. We're going to get into technical analysis and we'll spend some time on charting. We'll look at that at that time. But for the purpose of this example, your focus is on financials. Okay, that's where you get the numbers that you need for NCLH for this assignment. And to answer this question, is the question for tonight clear? Any question on what we have covered so far tonight? Please raise up your hand if you have a question. I will expect there to be 1 or 2 questions at this point. So we all understand it and we all can complete this exercise for Norwegian Cruise Line. Excellent. So that will be our assignment. Please do it. There's a reason why I give these assignments when we do. It's to help us to think through these things ahead of the next class. The next half of this training will be very numbers driven. Okay, that we will be looking at a lot of numbers and you can easily get confused. If you get left behind because you didn't do an assignment, the next one is building on that one. For example, today we were looking at income statement. We've not started doing income statement or studying income statement, but we're already looking at it. So next class, when we do income statements, I won't have time, or we won't have time as a class to go back and try to explain margin of safety or value, as it were. So when I use those terminologies, my understanding is that everyone is at the same point and can follow along. So if you don't do the assignment, you will fall behind class after class. And this is not where you want to fall behind. This is one of the most interesting and educative part of the class. All the class sessions we've been taking are all important. But as you get to the point now that I've gathered this knowledge, now that I've learned how to plan, now that I've learned how to set a goal for the future, now that I know how to, set money aside and put money in the
Bless
future,
you.
Where should I put the funds
Bless
that
you.
God has given me an opportunity to set apart? That is where we're at right now. To do that, you need numbers. And those numbers are what I want to show us where to get. Okay? So if there's no question, we will start looking at income statement, which in a sense we already started looking at, is the mostly part, will be talked about in the next class. But I will start looking at it tonight, and then we'll finish it out at the next class. Okay? All right. So the income statement, I was talking about ratios earlier on. We'll talk a little bit about some ratios tonight. Income statement is built into this format that I have on the slide on the screen right now. Okay, Every income statement will have the revenue at the top. How much money did the company make over a given period? Over the last year, over the last quarter, or whatever period is in question. What is the total money the company made from their business? The next line on an income statement is what they call cost of goods sold, or COGS in accounting terms. The cost of goods sold, the actual true cost of goods. When they cost that good, they put all the elements of the cost into it, including the cost of materials, labor that went into it, machinery that went into it, and everything must be included. If not, you might sell your product for $20 because you thought it cost you $10 to buy it. But really and truly, if you really think about what the cost is, you have to drive a vehicle to the shop to go and buy it. You have to pay electricity inside your shop. You have to do a couple of other things before you can truly sell that item. So the true cost may be another $3, $4 on top of the $10. So the cost of goods sold is a very important number. It's not just the product cost. It's the overall cost. In accounting terms, it said, it includes material, like I was just trying to explain, all the labor that goes into making it into a finished product. Okay, the overhead, all the actual labor that were into it that was not necessarily direct labor. It might be an overhead, it may be the cost of the manager sitting on his chair in the top office, but the salary they pay that man has to be apportioned to something. If not, you're not correctly counting your cost. Cost accounting is a very interesting subject. I really, if you have the opportunity to learn about it, you can deep dive a little bit. It's a very interesting subject to learn from. Okay. So the COGS includes, not only material, but also labor, as well as overhead, as that is directly relatable to that particular product. Okay. And when you subtract the cost of goods sold from the revenue, the first thing you get is what they call the gross margin. The gross margin. Actually, the gross profit, I should say. When you hear the term margin in accounting, it means percentage. Margin means percentage. So gross margin is equal to gross profit divided by the total revenue. So when we convert this number to a percentage, it's referred to as a margin in accounting terms. So when you're looking at a company to invest in, the first thing to think about is, do they even have a profitable business? And the way to find out is, does the company have a positive gross margin or a positive gross profit? If a company is in a business that is not profitable, that is, they don't have a positive gross margin, you don't want to invest in that company. So where do you find that number? We'll go back to our example that we're looking at. This is Norwegian Cruise Line. The total revenue, or in accounting terms, it also refers to as the sales of the company. Sales, in this case, let's look at the end of last year. Sales of 1.3 billion. Cost of goods sold, or here I refer to as cost of that revenue, 1.7 billion. So the gross profit is the difference between the sales and the cost of goods sold. Remember from the other PowerPoint. So the gross profit for them for last year is negative 413 million. Okay. So I'll ask you a question at this point. Will you invest in Norwegian Cruise Line at this point?
No.
I need
No.
somebody to answer. Yes or no?
No.
Why no?
They're not making money.
Because their gross profit, they are not
Why
making
are
money.
they not making money?
They are losing money.
Something is too much in
Negative.
introducing what they are making.
People are not traveling on cruise.
Thank you. That is the good answer. I don't want you to say things like they are not making money. That is too vague. Why are they not making money? Until you get yourself to the point that you think like that, you will make wrong decisions.
Yeah.
Why
I have
are
a quick
they not
question.
making money? Yeah, sorry, let me just finish my thought process. Really and truly, if you look at this company a little bit more closely, let me scroll to the right. Over the last 5 years or so, they've had positive gross profits. They made 2.3 billion in 2017, 2.7 billion in 2018, 2.8 billion in 2019. Then they lost 400 million in 2020. So the first question, now if it's a company that is negative, 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 then your first answer is correct. But this is a company that is positive, not just positive $1, positive 2 billion, 2 billion, 3 billion. Then your first answer is not correct unless you qualify that answer. You want to understand why. Now, go ahead and ask your question, please.
No, you just answered it, because I was going to say they're not profitable probably because of the COVID, that people are not traveling. So, but it kind of shows that because the previous years were positive. So it could be.
Exactly. So that's to your point, we want to always look beyond 1 year. What you want to think about is the trend. 1 year is not enough to take a decision. So what 1 year does for you is to help you to ask the right question. Why did they fall from almost $3 billion? That's about almost $3.5 billion swing in the wrong direction. And the answer came from the screen, from the class tonight. There is something that happened in the economy last year that actually hit this industry much more severely. I wouldn't go and take a cruise last year. I don't know about you. I wouldn't have gone on a cruise last year. Okay. So because people stopped traveling, even more so, some people were I still flew last year quite a bit. A lot of people still flew, but very few people went on a cruise last year because that is more of discretionary spending. It's a vacation. I could travel for work. I could travel to go and see family. I could travel for other reasons. That is almost compulsory. It's not discretionary. But the service offered by this organization is driven by discretionary expense. When you're doing your budgeting, one of the lines you may say, I'm cutting this year, is your vacation. It's your discretion to take it or not. Okay? So I just wanted to kind of talk a little bit about that, because if you look at just one item and you're not able to explain the why, then you might miss an opportunity to invest. But in this case, if you understand the why, I'm not saying you should invest in Norwegian Cruise Line or not at this point. I'm just saying, by thinking through the why, or maybe going and do some analysis, a little bit more analysis, look at the summary page. On the summary page here, you can get a lot of useful information or discussion that's going on between different people about the company. You can actually find out what is going on in that particular company. For some companies like this, it's pretty obvious, but in some other investment, it's not very obvious. I think in the last session, we were talking about GameStop. And we saw a big swing in the price of GameStop from like $20, $30, $40 to over $200, $300 in just a few days. So the first question you should ask is the why. Why is it going up? And by listening to news, reading articles like this, you can actually pretty easily figure out what is going on in the company. Okay, so I just wanted to spend some time because those are the thought process that we need to develop as investors, asking why, okay, and looking beyond one, looking at trend. If it's like negative the last 2-3 years, you just don't even bother. They need to really figure out what is wrong with their business and correct it. But for a company like this, that is not the case, so we now know why. And so we need to have other thoughts going on in our mind to take a decision if you're going to invest in the company or not. Does that make sense to everyone? All right. All right, the next item on the income statement is what they call depreciation. Depreciation, just as the name implies, is loss of value, something that is losing value. What happens in accounting is that companies are allowed to subtract a given amount of their income, of their revenue, as depreciation to pay for their assets that kind of get depreciated or lose value with time, so that the money they set aside, they can use it to purchase a new one. Let's assume I run a business, and that business requires that I put a vehicle on the road, and I bought that vehicle for $30,000. Every vehicle you purchase and use in the business, as you take it out daily, bring it in daily, it's going to begin to wear and tear. And what will happen is maybe after about 10 years, that vehicle can no longer run. So if you don't set money aside to buy a new vehicle, your business will run to the ground once all your vehicles get, worn out. To prevent that from happening, governments and Securities and Exchange Commission accounting bodies allow companies to calculate a value of their machineries and equipment and set it aside so that they don't get taxed for it. Okay, so it's removed before tax, almost like what I talked about on your 401k, it's like taking out before taxes. Okay, so depreciation is taken out from the profits and set aside so that the company is not taxed for it. Then there's the next level on the income statement is what is called the SG&A, sales, general, and expense. They call that item, okay, operating expenses, SG&A. The interesting difference between an SG&A and a cost of goods is what they call if it's inventoriable or not inventoriable. Okay, cost of goods sold that can be actually added to an item and recognized as part of the inventory that we will recognize when we sell it falls under COGS. But if it's not inventoriable, it has to be, you can't keep it because you need to report it as an expense that you've carried. Things like if you went ahead and did some advertisement, for example, to be able to sell that product, okay? You can't keep it and say this is, when I sell this thing, then I will recognize, you've already spent that money on advertising. It's gone. So you need to recognize it in your financials. And those kind of costs is referred to as period cost, not product cost. It's a cost that spans over a long period, more than a particular product, specific product. The advertising that you put outside, covers like a year, 2 years, whatever it might be, whereas your product is probably made and sold within a month, as it were. Okay, so those product costs, those period costs are not inventoriable. You don't put it in inventory and say, okay, this one, when I sell it, I'll recognize the cost. There are companies that do that wrongly, and they put that under product cost just for, to make some cover up, So as an investor, you want to look at what are the things they have under SG&A. Okay, so sales, general, and admin, things that are not inventoriable. Things like, it could include some salary. Now, if the salary is labor, remember I said labor is a product cost, right? The people that actually worked it, or even the overhead of somebody working in the office that is traceable to that particular item. Those are product costs. But there are some salary, like maybe the administrative secretary salary, the secretary to the CEO, something like that, right? Those cannot be traced directly to a particular product. And those falls under period cost. They are kind of ongoing costs that the company will incur. Okay, so there are some salaries that will still fall under period cost. I explained advertisement, money spent on marketing, research and development, or I said earlier on administration overhead, not the production overhead. Okay, administration type overhead, the secretary to the CEO or something like those are SG&A. Okay, so SG&A. So by the time I'm explaining these two, now explaining this next point, what is called operating income. That's the next line item you want to look for. The first line item, revenue, is the company selling anything. Gross profit is the product that they are selling being sold for a profitable number, which is where your gross profit comes in, or your gross margin. The next is the operating income. So operating income is gross profit minus depreciation minus sales, general, and admin gives you your operating income. All right. So we're going to switch over and go and look at the same company, NCLH, for example. I'll go to financials. Again, NCLH, actually, let me, because of what I said about NCLH, let's look at Walmart. Walmart is one of the most enduring businesses that we've seen, but their business model probably is not sustainable anymore because of Amazon, if they don't change. So they've also been making some changes over time. That's another thing I want you to be thinking about as an intelligent investor. What is the product this company is putting into the market or service? Is that product or service, is it sustainable? Do they still have a market 5 years from today? Are they doing something to pivot with changes in technology, changes in demography, whatever it might be? I used to tell a story to people. I don't know if I've said it in one of our classes before. In the early 2000s, I bought, there is a Palm, a product that used to be called Palm Pilot. Some of us may not know it or remember it. Palm Pilot came before like the iPhones or the Androids. Palm Pilot is, what they call a PDA, personal device, whatever PDA means. And Palm Pilot, the company that made Palm Pilot, they created a language for you to write things on their device. It was very small, like a phone. You can't make a phone call with it. But before Palm Pilot, I used to carry a diary around. So when Palm Pilot came, it was an advancement, a big change. I didn't need to carry a diary. I used the Palm Pilot to keep my what used to be kept in my diary, all my appointments and stuff like that, all my address of people and things like that. But so at that time, this was in the early 2000s, it was a hot seller. But rather than pivot as technology changes or be at the forefront of changes in technology, they felt that they have a product that was better than anybody. I think they were hardly doing any research and development. So what happened was that in the mid 2000s, Apple came out with iPod and then iPhones. And iPhone, with my iPhone today, I don't need on those PDAs, the Palm Pilots. It comes with a stylus, something to use to write on it. You have to learn the language. You can't make a call with it. I mean, it has its own technological thing for that period. But when iPhone came, I can simply use my finger to type my whatever I need to type, and I'm gone. I could make a phone call with this. I can do almost 10 or 20 more things, maybe even much more than I could do with a Palm Pilot. So people shifted from Palm Pilot to Apple devices. And then Android came also to break the monopoly of Apple, and they kept improving their products. So we have those companies that took over the personal handheld kind of devices. So the point I'm making is that when you investing at that point, if I went back to 2000 and I was supposed to invest at that point, I should be thinking, is this company doing anything to sustain their leading edge? If they are not, you want to be very careful in investing in such a company. Okay? You want to actually read their financials and see that they are spending some money on research and development. You want to actually read, underlining things or listen to underlining things happening in that company. If not, you will invest in the company, and then technology will come and sweep away the business, and you will lose your money. So you want to always be thinking about what's changing, which is why I was mentioning about Walmart earlier on. Walmart has been doing well, is still doing well, but if you compare Walmart to like Amazon has done much more better than Walmart just by looking at the performance of the company, not even just their stock. If you look at their financials, Amazon has done much more better in the same time frame than Walmart. I remember I read the story of how Walmart started by Sam Walton. The name of the book is titled Made in America. That's the name of the book by Sam Walton. They were the first organization that placed satellite in the orbit for the sake of managing their communication between their distribution centers and all their stores. So even today, when you go into a Walmart and you take a piece of item and you scan it on the scanner. The moment you scan it on the scanner, it reflects at their distribution center that item just left store A. And there's a new item leaving the distribution center to replace that item. That is how powerful their technology was at the time, which gave them the edge that they used to bring down their price and took over from the moms and pops that were running the retail business at the time. So they were on the leading edge, doing some things innovative. Then came Amazon, and Amazon, started as a bookshop, but they were very innovative. They're still innovative. They've gone in many different directions, and they took over the retail business essentially. So if Walmart does not do something, I wouldn't be surprised if in the next 10 to 15 years, there's no more Walmart. So as an investor, do I want to invest in Walmart? And now, I'm not saying don't invest in Walmart. I'm just giving you an idea of how to think as an investor. As an investor, do I want to invest in Walmart? Maybe, maybe not. If I do, what is my time frame supposed to look like? Do I want to invest in Amazon? If I'm comparing the two and I have a choice, I will more than likely choose to invest in Amazon today than Walmart. However, Walmart has shown that they can stand over the years. So if I was comparing Walmart and let's say another retail store, say that again? Like Kmart. My wife just reminded me about a company called Kmart. I don't even know if Kmart is still in existence today. This is such an interesting story about some of these companies. Kmart and a few of others. When Walmart Kmart came before Walmart. For those that don't know about the story, Kmart, was established before Walmart, and then there's Target and a couple of others. When Walmart placed their satellite in the orbit, and then they developed all these value chain improvements that brought their price down. They had done a good work to reduce their cost of goods sold. Remember the definition of cost of goods sold? They've done a good job to reduce their COGS. Everything that amounts to material, and the production associated overhead has gone down. Rather than Kmart figuring out what can they do in the same vein, they started to compete with Walmart on price. And to cut a long story short, it led to the end of Kmart. I don't think there's any Kmart still in existence today. Maybe there is. On the other hand, Target felt we're not going to compete with Walmart on price. We're going to differentiate ourselves. So Target went into their store. They remodeled their shops. They focused on high-end products so that those that will come and buy things in their shop are willing to pay that extra to buy what, in quote, is a better quality product. And what happened was that over that period, Target began to perform better than Walmart, whereas Kmart actually went down. Let's see how Target is doing. So Walmart is $139. Let's just look at Target. See, Target is $205, whereas Walmart is $139. And they were at the point they were kind of at par in terms of their share price and performance as companies. But Target, because they chose to differentiate themselves rather than compete on price, took off performance-wise versus Walmart. But Walmart still did better than Kmart. I don't even know if Kmart, let me just type Kmart here. See, we can't even see their name in the symbols anymore. Okay. So anyway, I think the company is probably gone under. That's Kmart. But the point I'm making is, as an investor, this is how I want you to think. Okay. How I want you to evaluate investment. What is the company doing? You have no business investing in a company that you don't know what they're doing. You're not, the money that you're putting into it, could be lost if you're not careful. Okay, so you need to know, what does the company do to make money? How do they make that top line, this top line revenue? What do they do to make sales? What exactly are they doing? You need to be able to explain it to me or to anybody else in very simple terms. Okay, so anyway, the point I'm making is, if a company is not managing, the core of their business well, you have really no business investing in the company. And if the company is not looking at the long term, figuring out to pivot as things changes in the industry, you have no reason to invest in such companies. So you need to be thinking about, what is the company doing now? Even if it looks like it's successful now, what are they, focusing on doing to stay ahead of the market, or at least abreast with the market? All right. Operating income. Any question on what I said? I know I kind of diverted a little way directly from income statement, but all of those things are important and they all come together. So the difference between the gross profits, the depreciation, and the SG&A gives you the operating income. Okay? Because what you do then looking at is other costs that are not direct product cost. You want to take it out, like the depreciation. Depreciation is still money in the company, but it's taken out pre-tax. SG&A, they are money that you spend that you can't really trace to that particular product when it comes to profitability, but you have to spend it anyway. If you don't spend money in advertising, people may not know your product, and as such, they may not buy your product. So they still need to spend that money, but that money cannot be tied to one product. It's going to be tied to many products over time. Those are SG&A. Okay, and again, margin, operating margin is operating income divided by total sales or revenue. And then when you get to that point, if there are other expenses that needs to be deducted, you deduct it. When you deduct that, you come to what is called the earnings before interest and taxes, EBIT or EBIT as it is called. EBIT, earnings before interest and taxes. Okay, so you want to make sure that the company you're investing in is still positive at operating margin and is still positive at EBIT. So let's go and look at Walmart. I think I opened Target already, and that's fine. We can't look at 2021 because that's still an ongoing number. So let's look at 2020, end of, actually, I think, yeah, let's look at, let's see. I want to see one that has the full numbers. I'll just use this for now. It's end of January 2020. I'll just use that for now. Okay, so you see operating expense, sales minus cost of goods sold gives you gross profits. You want to be sure that the company has positive and that also that the gross profit is growing. That's another thing. You saw in the case of NCLH that it was growing until it dipped because of what we explained. But here you see growth. A good company should have growing income. If the income is growing, but the gross profit is not growing, that means their cost of business is increasing faster than the rate of revenue generation. Okay, so you want to look at that. But in this case, there's a steady almost 2 to 3 billion or so increase on an annual basis in their gross profit. Good sign. Then you took out operating expense like I explained earlier, and that gives you operating income, right? Remember from the PowerPoint, you took out operating expense, your SG&A, and that gives you your operating income. Then from the operating income, you take out all other expenses, and then if there's this other income or expense, if it's income, it will be positive. It will be, if it's expense, it will be negative. That's why here it says other income, revenue, gain or loss. So there might be other costs that you've not recognized from the top that you need to recognize. And then you come to EBIT. Then you come to operating income, then other income expense, and then you come to EBIT. EBIT is really what is termed pre-tax income here, earnings before interest and taxes. Okay, so pre-tax income is your EBIT in a sense. Okay, so you see that their operating income is growing year after year, 16 billion, 18 billion, 18.5 billion, 21 billion. Okay, so they are doing something well. EBIT, 3.6 billion, 3.7 billion, 4.2 billion, 5.5 billion. That is what you want to see in a company you want to invest in. Continuous growth. Like I said, growth is normal if a company is well managed. If a company is not well managed, then these numbers will tell you, because rather than growing, it will be flat or reducing. That means the company is not growing year over year. You don't want to invest in such a company. Then you look at, so they'll subtract some money. If they borrowed some money to do business, they'll subtract some money for interest. And then at that point, you have your income before tax, or as referred in the other page, pre-tax income. Then they'll pay their taxes. Then this last point is what they call income from continuing operations. Okay, you can see there are different levels of income that have been explained here. There is the operating income, there's the income from continuing operations, there is the gross profit. Okay, so up to this point, everything must remain positive. So let's go back and look at it. Net income, they call it here net income, 2.93, almost 3 billion, same number, 3.3, 4.4 billion. So positive income all the way. So you are at this point, at that point, income from continuing operations. Sometimes they might place it one above the other slightly, but doesn't matter. Income from continuing operations, and then if there is some operations that they are no longer doing, they discontinue the operation, they may need to recognize those here for accounting changes, and then you have net income. For the sheet that I just showed us, they don't have that. That's why it went directly to net income. Okay. All right, so those are the key things I will show us tonight because of time. Next week, we will look at a couple more items at the bottom here. We'll start from the earnings per share. I explained basic versus diluted earlier on. It's the same thought process here. The diluted shares will always be higher than the basic. I think everyone in class understands. Does anybody still have any question about basic and diluted shares? For the calculation and the things, exercises that we'll have to do between these classes, please always use diluted because it's more reflective of what's going on in the company. Okay. The earnings per share is where we'll start at the next class. So if I missed that, I'd like somebody to remind me that that's where we said we will start. Okay. So any question on income statement before we close for tonight? No question. There's an assignment. Actually, I will want to, because there is more to the assignment than I've been able to cover. This class is actually supposed to be next week. We'll revise what we've learned tonight. The assignment
can
be this one. Yeah, there's somebody saying something?
Yes. And I know this is very unlikely, but since we know what happened with Enron. So we're making the assumption that every financial information that we see is accurate, and there isn't some kind of creative accounting to hide losses or to hide losses or not to give an accurate picture. Is that right?
Yes. So the question is, how can you identify such? Correct?
I guess my question is, are we sure that what we see or what we see on Yahoo or Bloomberg, that's actually accurate?
Yeah, very valid questions. So the truth is, we can't always be 100% sure, right? However, there is a process in place by Security and Exchange Commission where these companies are expected to file this, and their officers, are expected to be truthful. Now, you will always have cases like Enron, but again, that is where your work is as an investor. Reading through, the financial statement, trying to look at if there is a major change in trend, questioning it. We saw the one that this is in the negative, a swing of 3.5 billion. That's significant. Questioning such swings. Those are the things you can do. I mean, you're going to make some mistakes in these decisions, but your goal is such that you don't make mistakes all the time, which is why, if not, you will just buy on the stock price, right? You want to read the financial statement, understand it. Yahoo is a source, but the actual published financial statement of the company, which is obtainable from their website, is the more official source. You should be looking at that too. I don't want to make it that complicated at this point, but you should be looking at that and reading the states in the financials that they publish on their website. They are required to provide details of the numbers that they produce, which of course they won't put on Yahoo, right? So reading those, that is taking it to the next level. Really, most day-to-day investors will probably not look at that, but we will look at such information later. Every publicly quoted company should have such information. So you should be reading that. And the key thing is looking at big swings, looking at big changes, and looking at things that may appear suspicious, as it were. Otherwise, you won't invest in anything because you're going to say, is the number correct or not? You won't invest in anything. Let's say in the course of you're investing, one or two of them are fraudulent. As long as it's not all your 20 or 50 that are fraudulent, you're still going to come out well. Does that make sense? Does that make sense?
Thank you very much. Yeah, it does. Thank you very much.
Any other question? All right. So this is our assignment for tonight, and I will send it in just a few minutes after the class. Please think through it and use the spreadsheet that I'll provide, this spreadsheet, to answer the question. It's pretty straightforward, just like we did on this line for Occidental, to complete that assignment. I don't want to start another item now. If not, we will not finish in good time. So if there's no other question, that's where we'll end for tonight. We'll take it from there on the next class.